Hey, welcome back, options traders, and it's time for part two of our Zebra strategy series. This came about from a question from one of the traders in the group asking about a comparison between the Zebra strategy and the stock replacement strategy. But as I was laying it out, I realized it was going to be really long, so I wanted to just do a video on the Zebra strategy. So if you didn't see that, you'll want to go back and look that one up and check that one out first. But once you understand the Zebra strategy, let's look at part two and now compare it to the stock replacement strategy. Which one do you think is better? Which one will win? And which one will lose? Well, if you think there's an answer to that question, stick around because you're going to find out it's simply not true. So let's get started. And before we do, as always, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So why did I say that it's not true, that it's better, or that it's worse? And it doesn't matter which strategies you're talking about. And the reason is that whenever you're making comparisons with options, always remember one important thing, that all strategies involve trade-offs. All strategies, no matter how fancy the name may be, are long and short calls and puts. That's it. And if any strategy is better across the board, meaning that it either loses less or makes more money, but at no point does it underperform, that's an arbitrage. It's not going to exist. If one strategy is better in one area of your risk graph, it's going to underperform in another. So part of my point here is that before you get hung up on the Zebra strategy and somebody's telling you this is the way to trade options, back up and say, under what assumptions? Compared to what? And you have to say, all right, yes, it's possible that maybe it hedges theta. But you should also know that means it's going to come at the expense of gamma and vega. Which is more important to you? What are you trying to do? So just because you might be hedging theta doesn't mean that it's the be-all, end-all strategy for options traders. So before we do a comparison between the Zebra and stock replacement, let's just do a quick review of the stock replacement for people who might not know it or might not remember it. Stock replacement strategy is simply where you're going to buy a deep in-the-money call, generally around 80 to 85 delta. And what you're doing is trying to push those deltas so high that you're getting rid of or sharply reducing the extrinsic value. And so if you have no extrinsic value, you've got no theta, you've got no gamma, or at least very little to speak of. So you're all delta and no gamma, which is exactly stock. Now, it's not going to be exactly stock, but it's pretty close, and that's why it's called the stock replacement strategy. So this is a great tool whether you're just trying to buy shares of stock or control shares at a reduced price, or maybe you have shares that have had a tremendous run-up and want to hedge it. Well, you could sell your stock and just buy a stock replacement call. So that's what this person was asking in the group, if I could compare the stock replacement to the Zebra. So again, once you do stock replacement, the big key is that you will have relatively small extrinsic value. And because of that, it's going to behave almost like shares of stock, but at a greatly reduced cost. So to see it in action, here's shares of stock purchased for 100, and we know that we've got unlimited downside. This is the big risk, as we all have seen, especially during periods like COVID or during 07, 08. This is the big risk you take when you're holding shares. But if you do stock replacement, we get our little bend, our hockey stick. Let's say we buy the $90 call. Well, now you can see we've got our bend at 90, but the stock is up here at 100. So the stock is right here. So for the most part, you are operating in this region right here between 90 and on up. Could the stock fall below 90? Sure, but it's unlikely. But you've purchased a very cheap insurance policy, which is why there's not a lot of extrinsic value. That's the insurance policy. Why is it cheap? Because in this case, it was a 30-day, $90 call. So the chances for the $100 stock to fall here is pretty slim, not impossible, but pretty slim. And so it's a very cheap insurance policy. And so if it does come into play, it's going to rescue you. But if we do stay up in this region as expected, you can see that the black line sits a little bit higher than the red. The stock will outperform the stock replacement by a few pennies. So again, it's not a perfect substitute, but you can see that the red and black lines in this range are pretty close. So for the most part, it's behaving like shares of stock. But the big difference, again, is down here. By putting this insurance policy into place, you're eliminating all of this risk down here. So once again, it's a trade-off. Is it better? Well, if you knew for sure the stock was going up, take the stock. You will make more money. The black line sits above the red. But because we can never know that, no matter how strong your convictions may be, not a bad idea to put a little insurance policy down here. And in doing so, you're buying these shares, or at least controlling these shares, for a fraction of the cost. So in this example, you can see that it cost us just a little over 10 bucks. Well, that's 1/10 the price of 100. So if you bought the shares, you'd have to lay out 100 bucks a share, or 10,000 bucks for 100 shares. Here you're putting out 1,000 bucks, or a touch over 1,000, and basically controlling shares of stock, but also with a nice insurance policy. All right, so that's the stock replacement strategy. Now let's compare it to the zebra. So remember what the zebra strategy is. You're going to sell an at-the-money call, and you will buy two in-the-money calls, but you're going to go only so far in the money. Probably not as deep as a stock replacement call. You're going to look down your options chain, and you're going to find it to where each of those calls has half the extrinsic value of this short call. And again, as I explained in the last video, the reason for that is the person that put this strategy together says, okay, now you're going to completely hedge your theta. I've got a certain amount of extrinsic value in these calls, and I'm exactly bringing that in with a credit up here. All right, yeah, that's true. But that doesn't mean it's risk-free or that it doesn't create trade-offs in other areas of the graph. So for example, let's say that the stock is 100 and you sell a 30-day $100 call for 5 bucks. So this is your credit, and then you're going to buy two 30-day, let's say $95 calls that might be trading for $7.50 each. So remember that if the stock is 100, the 95 call has $5 of intrinsic value. You've got the right to pay 95 when the stock is 100. But they're trading for $7.50 each. So there's $2.50 over and above the $5 of intrinsic value. So that's $2.50 of extrinsic value. But because you're buying two calls, that's $5 total of extrinsic value, and then you're collecting $5 of extrinsic value, and therefore you have hedged your theta. Sort of. That's the idea behind this. But now if we go into a pricing model and use under the same conditions, same stock price, time to expiration, volatility, everything else is the same. And in this example, I looked at a 90-day stock replacement call that the pricing model said was worth $10.73. So this is what we're going to compare. Now again, it's going to be slightly different numbers, but you'll kind of come to the same conclusions. Do you want to buy a 120-day stock replacement or a 6-month, which is generally what you're doing with stock replacement? You're usually going out in longer periods of time because you're just trying to hold shares. But whatever the time frame is here, to keep everything else equal, I would use the same time frames for the zebra. So let's look at these two up here, buying two of the 30-day 95 calls, selling the 30-day call. And if we do that, that's our zebra, and this is our risk graph. This is, again, laid out in detail in the previous video. But if we compare this to the stock replacement with the 90 call, we get this. So again, we can see that there are areas where the red line sits below the black. In other words, it underperforms. But we can also see that there are areas in here where it outperforms because the red line sits above the black. And then over in here, the red line again underperforms. But this red line doesn't underperform across all stock prices. That would be an arbitrage. And this is really the key whenever you're analyzing strategies. Don't get hung up on the fact that one has greater profits or it's got neutral theta. All right, so what? What are the trade-offs? What are the expenses? So one good thing with the zebra, we can see that we have brought our break-even point in a tiny bit closer, because the stock right now, remember, is 100. So we're basically right there on the starting line and ready to start making any money for any upticks in the stock's price. But we're not that far below it. We're 73 cents. And we can see it because the break even for the zebra is 100, and then for the stock replacement is 100.73. So that red line is shifted to the right by 73 cents. Is that really worth it in exchange for having these 200 deltas down here that could really throw you off a cliff? Now, see, that's sometimes hard for traders to see or understand, but remember the stock is right here at 100. You're hoping that the stock moves here to the right, that you're up in this region of the graph. But think of your deltas as the slope of the line, because that's what they are. So think of it like a mountain where you might be snow skiing. You can see that the black and the red lines have the same slope. They're both 100 deltas at expiration. So there's no difference. Both traders are effectively controlling 100 shares of stock. And the person with the zebra strategy here in black is 73 cents ahead. That black line at all points in this region sits 73 cents higher. Is that really worth it? In exchange for realizing that if your snow skier comes down here to 100, he's going to go off a cliff. He's skiing down 200 deltas. He's going to hit bottom much, much sooner. See, if the stock hits here at 95, this guy's down only $5 roughly, whereas this guy is down 10. He's doubled the losses. So the zebra strategy in this case is simply giving you an increased reward, not by much, in exchange for increased risk. And so this is, which we've talked about in previous videos, this fits the definition of speculation. You are putting more money at risk in exchange for more reward. So the question isn't, what's the zebra and is it better and it's got a cool name and therefore I want to trade it? The question is, especially if these were your time frames that you were looking at, is it worth trying to capture an extra 73 cents in exchange for exposing yourself to these 200 deltas here to the downside if you are even slightly wrong? Now you might say, yes, but the zebra outperforms for all stock prices below 90. Again, not by much, 73 cents. But is it more likely for the stock to hit 95 or 90 or 85? See, the further you move down or to the left, the less likely it is. So you're far more likely, if you're wrong and that the stock falls, to land in this region. So the zebra is exposing you to a very big drop off right here with your deltas in exchange for very little reward. But now let's look at these over time. Remember that these are the expiration graphs. Let's say that maybe with 30 days to expiration. So we have the stock replacement in red, we have the zebra in black, and I used dotted lines for the current curves. So now you can see that the zebra doesn't have this sharp drop off if there's time remaining. They both look about the same. Not a very big difference between the two strategies. As time goes on, what happens? These dotted lines sink a little bit, and now we're starting to see, again, not too big of a difference, but you can see that through a lot of this, it's kind of hard to tell, but this dotted line sits below the black line. You're actually underperforming the zebra at expiration, and that's because the positive theta hasn't quite kicked in yet. Let's move it to 10 days to expiration. See, now the zebra is starting to sit below your stock replacement. The black dotted line is sitting below the red. This red dotted line will never go below this red solid line. We go to 5 days to expiration. See, now you're really starting to go off this cliff. And yes, you can see up here that the black line will rise in this region towards the solid black line. In other words, you have positive theta, but it's not a lot. And it didn't come for free. It's because you're exposing yourself to this much additional downside risk. That's it. So remember what I said before about comparisons. We have to realize that there are always trade-offs. That's the first rule. And the bigger issue is, what are you comparing it to? Do you want to compare a call to a put and say a call is better because it makes money if the stock goes up? Well, okay, that's true, but you're not really comparing the same thing. You're comparing apples and oranges. And the same thing is true here. If you're comparing stock replacement to a zebra, you're looking at different characteristics. And that's the point that I really want you to get from this video. It's not whether the zebra is the best strategy. The question is it the best for you under these circumstances? So let's look at a different comparison. Remember that the zebra requires the purchase of 2 in-the-money calls and the sale of an at-the-money call. So we have choices. What if we just wanted to buy 2 in-the-money calls and not do the sale of the at-the-money? Well, then we would compare 2 of the 95 calls versus the zebra. Now what do we see? Now you can see that you have 200 deltas here on the zebra, but you also have 200 deltas here on your long. See, we've now made these an equal comparison. Remember when we had the snow skier, I said that he was going off this cliff. Now that's no longer true because both traders have a maximum of 200 deltas. So what's the trade-off now? Well, now the trade-off is that if you are right and the stock moves up this way, the red line now underperforms the 2 calls. But if the stock moves down here, then the red line sits above the black. It outperforms. Both of them lose. The red and black lines are both below 0. They both create losses, but the red line creates smaller losses. So it still outperforms. So now you can see the comparison here. The zebra in red is reducing your reward in exchange for reducing your risk. It's shifting this left wing out here a little higher, but it's also shifting this right side a little lower. So it's simply a trade-off in risk and reward. In this case, it is a hedge. Now we also have to be careful. I've talked about this many times. I don't like using the word risk for the amount of money in a position, but that's how traders look at it. Remember, it's always about the probability. But one thing that we can say for sure about the zebra is it did reduce our break-even point. We will start coming into profit sooner, but it's not without a cost. It's going to give up these deltas compared to if we hadn't sold off that at the money. Now, what if we did 195 call? Instead of buying 2, let's just buy 1. Since this zebra has 100 deltas, we'll give ourselves 100 deltas. So let's compare it to 195 call versus the zebra. Now we get this. Now we can see that the zebra outperforms in this region instead of underperforming. It underperforms in this region because the red line sits below the black, but it's also got these 200 deltas through here. So it's exposing you to a lot more risk. So what is this comparison? Well, it's very clear. You have increased your reward because the red line sits above the black in exchange for increasing the risk because the red line sits below the black in this region. So now this becomes speculation. So if you're comparing or considering buying 1 call versus the zebra and saying, I have 100 deltas in both cases, that's true, but understand that is speculative. If you're saying, let me buy 2 calls like we saw in the previous slide because then I can compare 200 deltas to 200 deltas, that's fine. But then realize it's a conservative use. It's a hedge because now you're trading off deltas if you're right. So the main thing to take from this is that the zebra is long 2 in-the-money calls. And for most traders, they are going to be fairly short term. And then you are selling off an at-the-money call to offset the extrinsic value. The stock replacement is long a deeper in-the-money call, at least in most cases, and so it will also have very little extrinsic value. So think about it. The zebra has 2 in-the-money calls that are going to be a lot like stock, maybe not to the degree of the stock replacement, but they're going to be very high deltas. The stock replacement's going to be high deltas. So they should be about the same in those regions. And therefore, both of them will behave about like stock. The difference is that if you are comparing stock replacement to the zebra exposes you to 200 deltas if the stock moves against you. So it is simply speculation. You are trying to increase the potential rewards, not by much, in exchange for a lot more downside risk. So the question is not, is the zebra better? The question is it worth having this sharp drop-off in exchange for a tiny bit more profit and slightly less downside if the stock really collapses? And if you find out that it is, by all means, trade the zebra. But as I said in the last video, don't trade the zebra just because you think it has a cool name. Just like it's very hard to tell if a zebra is black with white stripes or white with black stripes, it's very hard to tell if this strategy is better than another because it depends on what you're comparing it to. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new Greeks class for 2025. There's also a candlesticks and technical analysis course. You can find it all at optionsA2Z.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.